In June 2025, the global economy is experiencing significant turbulence, with China's economic maneuvers and U.S. trade policies at the forefront. China's first quarter GDP growth surpassed expectations at 5.4%, driven by a surge in exports and robust performance in high-tech manufacturing sectors. However, this momentum faces challenges as escalating U.S. tariffs, reaching up to 54% on Chinese goods, threaten to dampen trade flows and investor confidence. These tariffs, part of President Donald Trump's aggressive trade strategy, have raised the average U.S. tariff rate to 22.5%, the highest since 1909, leading to increased consumer prices and a projected slowdown in U.S. GDP growth to 1.6% in 2025. The OECD warns that these protectionist measures are not only impacting the U.S. economy, but are also contributing to a global growth deceleration to 2.9% in 2025-2025. As Beijing implements stimulus measures to counteract these headwinds, the world watches closely, recognizing that economic decisions made in China have far-reaching implications for global markets and the financial well-being of consumers worldwide. China stands firmly as the world's economic juggernaut, second in overall GDP, yet unrivaled as the globe's manufacturing powerhouse, top merchandise trader, and the ultimate keeper of foreign exchange reserves. The latest numbers show a country that's both powering ahead and treading cautiously. While GDP growth is projected to cool from 5.0% in 2024 to 4.7% this year, Beijing stunned markets with a Q1 growth of 5.4%, smashing expectations and reigniting global optimism. The government isn't shy about fiscal firepower either, raising its official deficit target to 4% of GDP, while Fitch-adjusted estimates soar to a hefty 8.8%, reflecting bold stimulus in the face of international headwinds. Retail sales surged 5.1% year-on-year in Q1, and industrial output from major enterprises leapt 6.5%, with manufacturing itself clocking in at a striking 7.1% expansion. Yet not all sectors are basking in the boom. Property investment plunged 9.9%, exposing persistent stress in real estate, a crack that could send tremors far beyond China's borders. This complex, high-stakes balancing act underpins the ripple effect. Every shift in Beijing's policies or fortunes sends shockwaves through global markets, reshaping investments, supply chains, and consumer prices from New York to Nairobi. China's domestic economic policies in 2025 reflect a strategic pivot from an investment and export-led model to one emphasizing consumption and innovation. This transition is challenged by persistent structural issues, a beleaguered property sector with home prices projected to fall by 4.8% this year, a substantial local government debt burden, and subdued consumer spending that remains around 40% of GDP, significantly lower than in developed economies. Additionally, deflationary pressures persist, with the producer price index declining since late 2022. In response, the Chinese government injected a substantial stimulus of 10 trillion yuan, approximately 1.4 trillion US dollars, in 2023 November 2024, focusing on boosting household consumption and investing in strategic sectors such as advanced manufacturing, technological innovation, and support for small and medium-sized enterprises. While these measures have provided some support, the effectiveness is tempered by the ongoing challenges in the property market and cautious consumer behavior. The global economic order in June 2025 faces renewed turbulence as the Trump administration dramatically escalates trade hostilities with China. Building on the historic application of Section 232 and Section 301 tariffs, President Trump has not only doubled tariffs on steel and aluminum imports to 50% as of June 4th, but has expanded the tariff regime to cover nearly all Chinese goods. The average effective U.S. tariff rate has soared to an unprecedented 27% in early 2025, though it moderated to 17.8% by May, while baseline tariffs on Chinese imports reached a punitive 145%. In a forceful response, China has slapped minimum 125% tariffs on American products and imposed stringent restrictions on rare earth exports, key components for advanced manufacturing. The closure of the de minimis exemption for Chinese imports in May further tightens the squeeze on cross-border flows. The fallout from this tariff escalation is being felt throughout the global trading system. World trade volume, which grew by 3.3% in 2024, is now projected to stagnate at just 1.6% growth for 2025, following a brief spike driven by companies rushing to ship goods ahead of new duties. Supply chains are in flux, with businesses deferring investments and reconfiguring their sourcing strategies to mitigate rising costs, particularly in sectors heavily reliant on international trade. As direct trade between China and the US wanes, intermediary countries such as Mexico, Singapore, and Vietnam are emerging as key connectors, rerouting Chinese goods to the American market and reshaping global commerce patterns. For the US, the OECD projects a pronounced slowdown in GDP growth, from 2.8% in 2024 to just 1.6% in 2025 and 1.5% in 2026, largely attributed to the drag of higher trade costs. Globally, the effects are no less severe. Anticipated GDP growth is set to dip from 3.3% last year to 2.9% in both 2025 and 2026, as inflationary pressures from tariffs combine with softer commodity prices to create an unpredictable environment. Heightened policy and market uncertainty is chilling business investment worldwide, with especially acute impacts in sectors like steel and aluminum. While U.S. producers may benefit from protectionist windfalls, downstream manufacturers and consumers are already grappling with higher input costs and shrinking margins. The new wave of tariffs is not only reshaping trade flows, it is fundamentally redrawing the map of global economic relationships, with consequences that will likely reverberate for years to come. The ripple effects of China's economic maneuvers are strikingly evident across industries and regions, as seen in the responses of global companies now caught in the crosscurrents of policy and market turbulence. In the technology sector, titans like Apple Inc. have fast-tracked the diversification of their manufacturing, moving iPhone and MacBook assembly from China to India and Vietnam, a direct reaction to rising US-China tariffs and operational risks in the Chinese market. Semiconductor leaders NVIDIA and AMD have faced stiff headwinds as US export restrictions on advanced AI chips to China have dampened their 2025 sales outlooks, prompting them to search for growth opportunities beyond the Chinese market. Tesla, meanwhile, relies heavily on its Shanghai Gigafactory as an export hub, but now faces production realignments to avoid new trade barriers and supply chain uncertainties. Manufacturing and broader supply chains have also been forced into rapid transformation. Automakers such as Volkswagen and Toyota are recalibrating their sourcing strategies, shifting procurement and assembly towards Southeast Asia and Mexico to buffer against tariff shocks and potential disruptions from over-reliance on Chinese suppliers. Samsung Electronics, similarly, has scaled back some of its Chinese operations, favoring expanded smartphone assembly in Vietnam and India. For emerging markets and developing economies, the ripple can be both an opportunity and a challenge. As China retrenches its overseas lending, major African businesses like Dangote Group are finding it harder to secure financing for vital infrastructure and energy projects. Conversely, Southeast Asia's Lazada, backed by Alibaba, has benefited from trade diversion. Chinese goods are increasingly shipped via connector countries such as Singapore and Vietnam to reach the US market, bypassing direct tariff exposure. Commodity-dependent nations and their corporate giants are also feeling the pinch. Australian mining leaders BHP and Rio Tinto face revenue pressure as Chinese demand for iron ore and coal wanes, leading to softer commodity prices and currency volatility. Brazil's Vale, the world's top iron ore exporter, has seen its fortunes fluctuate in tandem with shifts in Chinese steel demand, underscoring the risks of heavy dependence on the world's second-largest economy. As these corporate case studies show, the China ripple is not an abstract concept, but a lived reality for boardrooms and workers across continents. Every policy move from Beijing and every escalation in trade friction demands a strategic response, reshaping supply networks, investment plans, and global ambitions in real time.